All right, so hi everyone. I'm Colin. If you don't know me, I just graduated Princeton. I studied electrical and computer engineering. My kind of research topic was deep reinforcement learning, and I kind of did it in the cross section of finance. So please, if you have any questions, just drop them in the chat. I'll be happy to answer them. But today I want to talk to you about kind of like something I've been doing for a while, which is AI in the stock market, kind of just a broad overlook because there are a lot of intricacies with it. So without further ado, let's get started. So just starting off, what we're going to cover here is kind of the three things that I think about when I do AI. So first of all, data. Getting data is a messy process. Then we talk about our models. What models do we want? And then you kind of have to sit back and say, what issues does this model face? What issues does this affect with people? And kind of all the ethical things that come around this big AI bubble. All right. So in the chat, can people start saying what they think affects a stock's price? Investor demand, yes. Supply and demand, yes. Great terminology. People are smarter than me when I was your age. Stocks perceived value, yes. Intrinsic value. Elon Musk, yes. I always see Elon Musk when I ask this. Country's economy, yes. The demand. News, yes, right? Sentiment. GameStop, another good one, right? Bringing it back to Reddit. Yes, all big things that go into what affects the price. So yeah, someone hit it right off the top. So yeah, supply and demand at the highest level. This is kind of what builds around the market, right? People, if there's a lot of supply, there's a low price. If there's no supply and if people want it, there's a high price. And that's kind of what we're seeing right now in the market. No one wants to hold anything that's risky, so everyone's selling off. Supply is high and the prices drop. All right, so other factors, I saw someone said something about perceived value. And that's such a true thing because unlike me, some people are smarter and actually read into what they invest in before they invest. And exactly, perceived value. There's a ton of things that help us understand what the perceived value of a stock is. There's something like earnings per share, which is EPS, or price per earning. And these all come from these fundamental reports, quarterly reports, or annual reports that are just pages and pages of information with just all these different numbers that are calculated out. And that's a huge thing. And that's kind of going to be our data set for our models here. Any questions so far? Kind of went through the data really quick, but this is kind of the big thing we're going to touch on with data. Just all these numbers that companies actually give us, and the numbers we're going to have to somehow extrapolate through the grapevine with NLP, which the NLP and finance group knows. What is the goal of our model? Like, what are we actually trying to accomplish here? What are some different goals we can have when we're playing with the stock market? So if someone gave you an AI bot and they said, go run this on the stock market, what would you say if it's open-ended? To make money. All right, great. Obviously, that's the whole point of the stock market, right? Predict whether the market is going up or down so you can invest in good stocks. Absolutely. What else could we do? Prevent losing money. Yeah, absolutely. Detect market failures. Yeah, find all the little pinholes in the market. All right. Great ideas, everyone. Great ideas. All right. So I broke this up into 3 subcategories. So supervised learning, which we're all kind of familiar with, right? We have classification and regression. So someone said it, determine if a stock's going to go up or down. And this is a fun little process here because in classification, you can set it for over different time periods, different thresholds. And you can say, is it going to go up this much? Is it going to go down this much by, today's still June. So is it going to go up or down by July? And you can invest. Is it going to go up or down tomorrow? Is it going to go up or down by Monday? All big things we can do with classification. And another fun one is regression. So if you want to actually try and predict the true price of a stock, we can do that. We can use something like linear regression. If you've ever seen, I hate to say it, and I've seen TikTok. If you ever seen TikTok, they all like to do like the lines, all the trend lines, and we can do that with regression. We can do that with supervised learning, trying to predict the actual true price of it. Awesome. Any questions on supervised learning? Kind of everyone here is bread and butter. So the next one, kind of didn't know this was a huge one until I actually started working, but unsupervised learning is very important. Pattern recognition. So discovering things that we might not be able to find, right? So just finding patterns that an asset may be increasing or decreasing in the near future, looking at tons and tons of stocks, putting them all together, seeing all their fundamentals, all their technical data, and saying these went up and these went down. And you've learned to find these very, very interesting patterns. They're going to say, is it bearish or is it bullish? And it's a very fun little process there. It's this fun process. And think about K&N, right? We're clustering, putting them into kind of abstract groups. And you're saying, wow, these all have the same little factors and they all went up. And the others have all these same factors and they all went down. It's very, very important to see what's going to go up and what's going to go down. Going back to Zavi's comment, stock markets to make money. My favorite thing, reinforcement learning, right? Building something that can do something for us. No longer we're just getting kind of predictions and forecasting. It's not just showing, it's just not showing us data in a different way. It's actually doing things. Reinforcement learning. So I have automated trading. So we're just analyzing the information of stocks. We're trying to create a policy or a set of rules that can maximize the amount of profit. So this is actually very, very fun. And it's actually very fruitful as well. Right. So you have all this fun data, nasty data, however you want to look at it, and you get to feed it into this pipeline. And we have our AI bot, I'll call it, that just churns through it and says, well, if I go this way, I make money. If I go this way, I lose money. And over time, it learns how to make money. And at the end of the day, you run it for hours and hours and hours to keep learning. It ends up learning that the stock market is a profitable business and just keeps going over and over and over again. Another way this could be used is in portfolio management, not only just trading, saying buy, sell. It could also say buy this, sell that, hold this, and it builds your portfolio for especially times like this, recession proof and things like that. What are the biggest issues AI faces, especially in this field of like the stock market and finance and things like that? What are the biggest issues it faces? Feel free to drop it in the chat. Feel free to yell out. Bugs. Sure, bugs are something that keep me up at night still to today. Biases, yes. Yes, biases are a major thing and you kind of have to poke your model in the right direction. Can't keep up with important current news. Yeah, I mean, it's always about how quickly can we get news in. The people are trading at high frequency, sub-second. How do we keep it up with the second the New York Times releases an article? How do we get that article in as fast as we can? Absolutely. Great ideas, great ideas. But yeah, I love the idea of biases because you definitely have to poke algorithms in the right direction. So I guess we're starting to get away from GameStop a little bit at this point. Right? I think that happened last year. But GameStop. GameStop had no fundamental reason to climb. I know it climbed, but it had no fundamental reason to climb. But it's all social factors. You have to remember the market is 68% individual investors. The other, what is that? 32% is held by firms, but 68% is held by the individuals, people like you and I. And we have the power to decide if a stock's going to go up or down. And Reddit did that. There was no reason for it. You can't put that type of data into a model, and well, you can with NLP, but no one thought of it. Reddit is a place that no one believes in true information, but it took off. So there's social factors we just cannot encapsulate in a nice package for our models. Another one is just extreme actions, this crises, panics. We had the COVID-19 shutdown and the market just dipped down. We're having a Ukraine crisis right now. We're having a gas issue right now. And all these things are just piling onto the market and no one saw them, right? They just blindside us. They just happen one day and there's no reason for it. You can't predict it. No one prepares for it. No one ever believes anything bad will happen. And then it spikes down. And these models aren't prepared to predict, aren't prepared to take actions against it because they don't expect it to happen because it doesn't usually happen. And then I believe this is my final slide. And I just want to talk about kind of computational power. Someone said not getting news quick enough, I believe, something along those lines. And yes, you're absolutely correct. On the left here, we have Tesla stock over 15 minutes. Just 15 minutes and it's going up. It's hitting really high peaks. It's hitting really low valleys. And you just have to constantly be just intaking and intaking and intaking all this information. And you have to somehow take it in. You need a lot of computation power. You need to constantly be pulling data. You need to constantly be understanding data. And then on the right, it's just kind of a very, very snippet of just what we have to deal with. The S&P 500, 500 stocks. There are, if I remember this correctly, there are 16,000 publicly traded companies that you can buy in the United States. Not all American companies, but just across international companies. I believe there's 16,000. Now we have to take 15-minute data that looks like that on Tesla and do it for 16,000 stocks. And it gets very, very dense, right? We have all this information, we have all these companies, and somehow we need to intake it in a meaningful way that allows us not only to get predictions, but also allows us to physically handle this data, which is a big, big issue. And that's why model training takes so long. And we have AWS.